Okay, so if you own one piece of real estate or 10 pieces of real estate or 100 pieces of real estate, you need to watch this video because I'm about to tell you one of the biggest tax concerns most people have. So currently, tax laws state that all rental income is considered passive income. Now, we know that some properties that we own, some investment properties, you make cash flow, make a profit on it. Some other properties, you're going to make a loss on it. Now, if you make a loss, that's considered a passive income loss. Passive income losses cannot be deducted against any other income, such as your job, such as investments, stocks, bonds, anything else. They can only be deducted against other passive income. So that's one really big thing to keep in mind, especially if you're a small landlord. You only own 1 or 2, 3, 4 properties, and you have a negative cash flow on multiple properties. So that's a huge problem because you cannot take those losses and deduct them against your actual income. So there are 2 exceptions to this. One exception is you could be considered a real estate professional if you work at least 750 hours managing your properties. Now that's extremely, and again, it's extremely hard to prove, especially when you own less than even 10 or 15 properties. That's pretty tough to prove. So that makes it very difficult for most people. Now the other exception is if you make less than $100,000 per year in income on your other occupation, you can deduct up to $25,000 in residential or in rental income losses. Okay, so the limit is $25,000 if you make $100,000 or less. That number drops in various amounts up to $150,000 a year income. So if you make over $150,000 a year, you're not going to be able to deduct any passive income loss off your rental properties. So that's one thing to keep in mind. Keep it in mind, and you're going to want to talk to your CPA before making any big decisions. Sometimes with rental properties where you have negative cash flow, it is better to sell the property, especially if you can't deduct any losses or the losses that you can deduct are very minimal. In other cases, it may still be worth it simply because you may have a lot of equity in the property and there's a few other things you can do. So I'm not a CPA. Talk to your CPA before making any big major financial decisions, and hopefully you learned something today.